So welcome to the second video in our economics definition series. So in this series, we'll just be going over each of the chapters one by one and explaining you some of the definitions in each chapter in order of how you see them as opposed to alphabetical order. So in this chapter, we'll be taking a look at how markets work and all the definitions you've got here. In this chapter in particular, there's actually quite a few equations which you need to understand. It's quite heavy in terms of definitions. So this is probably definitely one of the longer chapters in terms of learning definitions. So yeah, let's just jump right into it and take a look at how markets work and all the definitions there. So the first one which you need to know is what is utility. So utility is a measure of satisfaction which you get from buying and consuming goods and services. So this is just the idea that when people buy goods and services, why do you get it? It's usually for some form of satisfaction or something they want. So the way you measure that is essentially just, we call that utility. It's the satisfaction you get from doing something like that. Then we've got demand. So demand, obviously, demand and supply you hear about all the time. But what actually is demand? So demand is a quantity of a good or service which consumers are both willing and also able to buy at a given price in a given time period. What I mean by that is it's really important to understand this willing and able to buy part. Like, I might be willing to buy a Ferrari when I was 10 years old, but I'm not able to buy it. So you can't really count me as having a demand for it. Demand you only really can consider as the people who are willing to buy something, but also able to buy something in a given period of time. So if you're going to ever give this definition, just remember to include that part. So total utility is just a total satisfaction you get from buying and consuming a given total of a good or service. So it's kind of like saying, if I buy 10 cars or if I buy 10 chocolate bars or 10 items of food, what is my total utility? Or it could just be if I go shopping and I buy a lot of different things, if I add up all the different utilities from all the different things I bought, then that would be my total utility. And this leads on to the idea of marginal utility. So marginal utility is the additional satisfaction you get when you consume additional units of a good or service. So it's the idea that, well, I've said it before, but the word marginal means what happens if you do one more of something or an extra unit of something. And the theory of marginal utility just kind of says, if you do one more of this, then what is the total benefit and what is the total cost you have as a result of it? So marginal utility looks at just, if I do something more, if I buy an extra item, or if I do something more, then what is the extra satisfaction I got because I did one more of it? And then again, actually, this also does lead on to the law of diminishing marginal utility, which is the idea that every time you buy more of something, the extra benefits you get from that will actually decline over time as you consume more of them. So, and this actually explains why your demand curve is downward sloping as well. The idea is that if I bought my first car, it will give me a lot of utility. But if I bought a second one, while it will give me some more utility, it won't give me as much utility as my first car did. And definitely if I've got my 100th car, it doesn't really make a difference whether I had 99, 98, 97 cars, because the utility I got from getting that one extra car isn't that much. So the idea is, as you have more and more of something, the utility you get from having each extra item starts to go down. That's the law of diminishing marginal utility. Okay, and then the next few sections, we've got a lot of equation questions to take a look at in this section. So you've got price elasticity of demand. And price elasticity of demand is just the responsiveness of demand to a change in price, which is the percentage change in demand over the percentage change in price. So it's basically saying, if your price changed a certain amount, how much does your demand change? So if your price changes a little bit, but demand changes a lot as a result, then you say it's elastic. So it's price elasticity of demand. So is it elastic good? But if you change the price a lot, but demand doesn't change much, then it's an inelastic good. Total revenue is one of the easiest definitions in this chapter. Total revenue is just the price times the quantity sold. So it's a pretty easy one to do. And then you've got cross elasticity of demand. So cross elasticity of demand is just the responsiveness of demand for good A compared to the price change of good B. So it's percentage change in demand for good A over the percentage change in price for good B. So it's just trying to say, if a certain good changed by a certain price, how does that affect the demand for another good? So if, like, I don't know, if I say the price for, I don't know, tomatoes went down, then how does that affect the demand for ketchup or something like that? Or if the price for phone cases went down, how does that affect the demand for phones? Then you've got income elasticity of demand, which is just how responsive demand is to your income. So it just looks at if your income changes by a certain amount, how much does your demand change. So it's percentage change in demand over percentage change in income. You just kind of have to remember the definitions for these ones, since compared to just stating them, you'll be using them quite a lot. Then we've got substitute goods. So a substitute good is a good for which there exists another alternative good. And then this is the important part, which could be used for the same purpose. So if you could either get Heinz ketchup, you could also, you could get Tesco ketchup as well. It doesn't matter. You can substitute these goods for one another. And for these substitute goods, you'll find that the cross elasticity of demand is positive. And then you've got complementary goods. And these are goods which are often bought together with another good. So like before I said, if you buy a phone, it's quite likely to buy a phone case with it. Hence they're complementary goods. So for these goods, your cross elasticity of demand is negative. Then we've got normal goods and inferior goods. So these are both related to your income elasticity of income. So sorry, it's the income elasticity of demand, my bad. So yeah, that's what normal good and inferior goods are related to. So a normal good is a good which sees an increase in demand as your incomes rise. So it's pretty much most goods. That's why you tend to call them normal goods. As your income rises, you want more of that good. So that's why your income elasticity of demand is positive. And then you've got inferior goods, which is just the opposite. So if you have more of an income, then you see your demand for the item basically decrease, which is why you say that your YED is negative. Okay. And then we've got these things here. So we've got inelastic goods and elastic goods. An inelastic good is just a good which has a PD between 0 and 1. So if the good changes by price by a certain amount, then the demand of the good would change by a smaller amount in the opposite direction. So it's kind of like, it's what we've actually already mentioned before. So inelastic goods is, okay, the price changed a little bit, or let's say it changed a lot, but the demand hardly changed. So that's why it's inelastic. So alcohol is an example. You can double the price and probably a lot of people will still buy it, because it tends to be goods which people really want or might be a necessity, or they might be addicted to it. Elastic goods just the opposite. So if your PD is greater than 1, then the idea is that the price changes by a certain amount, then the demand changes even more. So it's like chocolate bars. If you double the price of a chocolate bar, probably a lot fewer people are going to buy it because it's an elastic good. Okay, and then we've got the long run, which is just a period of time during which all factors of production can be varied. So we looked at factors of production in the last video. So when land, labor, capital, enterprise, when all these factors are essentially free to be changed, that's the long run. Because in the short run, sometimes you can't change these. Like you can't suddenly get more workers tomorrow. You can't suddenly buy more machines tomorrow. That's why the idea of the long run is the period of time through which all factors can be varied. Then you've got equilibrium in terms of price and quantity, and this is where the demand and supply that you have are both equal. So market forces won't change the price of demand from this point. Essentially, if you had a graph like this, it's just where this part meets that part. That's in market equilibrium. Then we've got excess supply and demand. So excess supply is just where your prices are way too high, which means that your supply is greater than demand. So if I kind of give an example down here, just really quickly, if you know this is supply, this is demand, excess supply is where your price is too high. So you can see that this is your price, then your demand is here, but your supply is here, and that gives you a gap of this much in terms of your quantity for both. And that's your excess supply. Excess demand is basically the same thing, but your price is set too low. So let's say again, that's supply as demand. If your price is set too low, that's your supply, that's your demand. So you've got this much in excess demand. So that's just where your price is too low, and then your demand is greater than supply. Consumer surplus is where the difference between the price the consumers are willing to pay and the price they actually pay. So that's what consumer surplus is. So it's basically that idea that there's a price that I'm willing to pay for something, but then the price I actually pay for it, that will give me the consumer surplus. And producer surplus is the difference between the price the producer is willing to charge and the price that that producer actually ends up charging. So that's essentially what producer surplus is. So cool. Now let's move on to the final few things to know this topic. So that's taxes. So indirect taxes are just a charge on producers of goods and services, which is paid by the consumer indirectly. So what I mean by that is that the government might tell a producer, like, okay, I'm going to put this tax on your product, like 20% VAT. And then the producer says, fine, I'm just going to increase all the prices of my goods by 20%. And in the end, who's paying for it? It's you as the consumer because you're buying it, the prices went up by 20%, so you're kind of making up for that cost that went up. So that's why we say you indirectly pay for it as a consumer. So government charges producer, producer passes on to you, you paid for it indirectly. It's very important when you have indirect taxes, you explain this part that it's a charge on producers of goods and services, which is paid by the consumer indirectly, and not just give examples like VAT, because a lot of people do that. When it actually comes to specific things like what's an ad valorem tax, that is an example of an indirect tax which is put on a good, which depends on the value of the good. So the more expensive something is, the more VAT you're paying on it. That's the main point of ad valorem taxes. So that's basically VAT. Then you've got specific taxes, which is a tax on a good where the value of the tax depends on the quantity of the good. If you buy more cigarettes, you're going to pay more in terms of tax. So that's a specific tax. Then you've got incidence of tax, which is just a tax burden on the taxpayer. The incidence of tax literally just means the taxpayer essentially paying his taxes and having the burden of paying it. So you probably won't get asked this as a definition. It's more just for you to know, so you understand what it means when someone says what's an incidence of tax. And finally, you've got subsidies and behavioral economics. So subsidies are just payments made by the government to producers in order to lower their cost of production, encourage them to increase production output. Basically, the government says to the producer, look, here's some money, here's a grant. As a result of having more money, the producer can buy more equipment, hire more people, reduce their costs of production, and produce more of something. And finally, behavioral economics is just a study which puts together psychology, economics, and all of those kinds of subjects to understand problems through how humans behave. So in behavioral economics, we try to understand, okay, how is a human going to behave if, this thing changes or that changes? Because a lot of what happens in economics depends on human behavior. So we need to include elements of psychology just to understand human behavior better. But that's basically the entire chapter. So in terms of this chapter, how market works, there's a lot of diagrams which you'll need to know, which you should go through in your textbook. And I actually have another video to that. I might link it below. But I've also put this definition sheet below, so you can actually have a look at all of the different things which you need to know for it, and you can use that for your revision. So hopefully that helps. But that's basically everything for how market works. So I hope this video helped you. And if you have friends to share this with who are struggling, or just, it would help me a lot if you just share this around with people, so that it would encourage me to keep making more videos. And hopefully this helps. So good luck, and I'll see you in the next video.